Good evening. I'm Jabari Morris, and this is MMT Mondays. Tonight, we will explain the difference between bank credit and the currency that comes from a central bank or government. After this episode is done, we will understand the importance of spending on the federal level versus private debt creation. Make sure to hit the like and subscribe buttons, and let's get to it. In this opening video, we will look at the way banks create money through loans.
There is a very, very good chance that most of you watching this video today have never seen a gold coin, let alone actually used it to trade for anything. Since the times of ancient civilizations, we have moved from transacting in gold to pieces of paper that were transferable to gold to just regular pieces of paper, and now today, most of our transactions happen with digits on a computer screen. And that's exactly what happens with your money today. When you go out to take a $400,000 loan, the bank basically opens up a very secure Excel spreadsheet and types in $400,000. Then hey, presto, you have that money in an account that you can use to buy your house. The bank can't do this endlessly. In most nations, they still have to have some genuine cash on hand to back up this imaginary money, but still, a large majority of the money created today is not printed out. It is literally just typed into existence in the form of credit. This is such an abstract concept that a lot of people don't quite fathom its raw simplicity, so I find it's often easier to explain it like this. Say you are playing a video game like World of Warcraft or RuneScape or my favourite EVE Online. All of these games have some kind of currency, be it gold or credits or ISK, it doesn't matter. It functions effectively the same as cash that we know and love in our everyday lives. Now, the game developers in this game effectively have the power to log into the back end of the server and type whatever figure they want into the bit of server memory relating to your wallet. If they wanted to type out 1 trillion gold sitting in your wallet, they could. They're only really limited by how long they want to sit there pressing zeros. This sounds simple enough, but exactly the same thing is effectively true for real cash. But, in the same way that a game developer would probably get fired and also completely ruin their game if they just went around maxing out people's wallets, the same kind of rule applies for banks today. Things like reserve requirements and responsible lending standards means that there is an effective limit on banks' money generation, but the process is still effectively no different.
Clint Ballinger shows the difference between vertical money from the currency creator and horizontal money from banks in this clip from an episode of Macaroni and Cheese.
Traditionally, sometimes this has been called endogenous money, although for certain reasons I don't like to use that term. Basically, vertical money is public money and horizontal money is bank credit money. I think I mentioned earlier something about I was influenced a lot by Jane Jacobs, and she has this great saying where she says, "Why be vague when we can be specific?" So one of the problems you'll see, and I know we've all seen this in debates about these topics, is a lot of the problem is people talking past each other with different terminology and different understandings of debt and money and credit and so on and so forth. So if I'm talking about vertical money, I try to only discuss exactly what I'm talking about, which are the tax credit token, which can either be reserves in the system or cash, although cash is less important, and then try to get the public to understand how that's a public monopoly, and then everything the MMT says follows from the fact it's a public monopoly, and then understand that bank credit or horizontal money is just promises to pay in those, so that the public kind of hears discussion about money being debt and all that, but they don't fully understand necessarily that what banks are just entities that promise to pay on your behalf, and they make payments between themselves and with the government with actual tax credit tokens or reserves. And the purpose of their promises to pay is system one, our horizontal system that increases our productivity, funding capital projects. So basically, that's the difference between the two. As a matter of fact, I really think that this way of organizing makes more sense than the common macro-micro distinction we make. I would like to see all of economics, or at least for a 4-year degree, follow in the horizontal and vertical systems would be the division, not micro-macro. And then on the macro, you would have all kinds of classes for more advanced students going into welfare economics, going into taxing, spending, fiscal policy in general. On the one side, that would be the vertical side, what I call system 2 in the book. And then you would have another series of classes dealing with what I call System 1 in the book, or the horizontal side, which would be about how to properly regulate financial markets, financial stability. You can even get into the micro of banking and loans and how they affect businesses and individuals. So that would be the micro aspect. But I see this way of dividing into vertical and horizontal money as a viable way to organize an entire economics course for 4 years.
In this interview with Sabby Sabs, Professor Fadhel Kaboub explains how banks are federally chartered to create money through the lending process. However, they do not print money.
Some people will say, well, most of the money is actually not created by the government. Most of the money is created by private banks when they lend money to people. Well, the only way for private banks to legally create money is to actually have a legal document called a banking license. Who gives them the banking license? The US federal government, which gives them a specific license to create money, not print money, create money through the process of lending. And it's a very important legal and accounting mechanism that they use. It's not unregulated. So when I apply for a bank loan and the bank approves my loan, they do two things. When you sign the mortgage document, sign here, initial here, sign here, initial here. There's one important legal document, which is the promissory note. It's actually called this promissory note, which literally means I promise to pay you back. That's what I sign. So they give me $200,000 to buy a house. I sign a promissory note. That promissory note becomes an asset for the bank. They own it, right? And it's legally backed by the power of the court system, the US federal government system, to make sure that I pay what I promised to pay. So that's an asset. As soon as I sign the loan, two things happen. The bank has an asset of $200,000, that piece of paper that I signed, and it adds to their asset side of their accounting. And at the same time, the liability side of their books is the $200,000 that they just deposited in my bank account, so I can go buy a house or a car or whatever I'm buying with the 200,000. So simultaneously, they increase their balance sheet by $200,000 on the asset side, $200,000 on the liability side, and it's got nothing to do with how much they have in deposits from other customers. So they're not borrowing from other customers to give me the loan like most people believe. And there's nothing legally stopping them from increasing my loan from $200,000 to $2 million if I had, the resources to borrow that much money, other than doing their due diligence, which is required by the government. And this is where the regulation comes in, to make sure that I'm good for it. Apparently, I'm only good for $200,000. I'm not good for $2 million because I don't have that kind of income to support a loan like that. So that's how banks create money, through the process of lending, because they're given a legal license from the federal government. And that license is very specific. It's a huge privilege that banks have to create money, to direct economic activity in real estate speculation versus industrial production versus healthcare versus education. It's a huge power that we're delegating to banks. And when we gave banks these banking licenses, we told them, you're allowed to do this. You're given this responsibility. You have to do your due diligence, which means you can't just lend money to your friends left and right and ruin the system. And most importantly, you have to serve the public purpose, what we, the United States government, consider the public purpose: building infrastructure, funding economic activity that will grow our industrial and agricultural capabilities, and so on. But what we've done since the beginning of the Republic is that we forgot that they actually have to serve the public purpose. We forgot that we can actually take away their banking license and give it to another institution that does it better. We forgot that we can even take it away and give it to the United States Postal Service to be the public bank, to direct financial resources to fuel, good health in the economy. Why? Because the system was hijacked by Wall Street to the point where we now believe that the federal government, the sovereign issuer of the currency that gave that exclusive privilege to banks, we believe that we, the federal government, need to borrow from them.
We can clearly see the difference between money created through the private lending process versus currency created by a central authority like the Federal Reserve. If you enjoyed tonight's video, make sure to check us out at realprogressives.org and subscribe to get notifications on new video streams in YouTube, Periscope, Twitch, Facebook, and Rockfin. Thank you, and continue learning.